Hello, it is Scott Newcomb with Zenby AI, and welcome to the Systems Are Sexy podcast. Today, I am joined by Reid Goossens. He's the founder of RSN Property Group. He came to the United States from Australia in 2012 with no network, no track record, and no guarantees. But over the last decade, his team has completed nearly $1 billion in acquisitions and built a true ecosystem around syndication. So welcome to the show, Reid. How are we doing today?
G'day, Scott. Thanks for having me.
I'm always interested as entrepreneurs start their journey, and I know we chatted about this before, kind of like the 0 to 1 moment. What was it for you where you felt like, hey, this might actually work as a business for me?
Look, I think it's not necessarily the aha moment, but it's more to do with maybe my background. So, when I first got started, it was just buying real estate, right? By getting involved and knowing that I needed to have real estate in my portfolio, working as a professional in the United States. It wasn't until I started seeing other folks building AUM, assets under management, or EUM, equity under management, that you can start charging recurring fees and start really building a business around capital raising and syndication to manage these investments, right? It's a very, very simple 2% and 80-20 model for those folks who may or may not be familiar with that. And that's really where I got started to see the bigger picture, to go out and build the team and buy more assets. Obviously, with that, there's the ups and downs of raising equity and finding the deal, or finding the deal, then raising the equity and all that sort of good stuff. So even to this day, it's an ongoing issue. But the fundamentals of what we do is that we raise money, and fund manage and go and then buy deals and manage those deals.
Got it. Yeah, I think that's a good idea. Maybe people aren't familiar with your company. What problem you guys solving? How do you differentiate yourself a little bit from what the other competitors out there?
Yeah, look, we're a private equity company. We raise money, as I mentioned, to go out and buy commercial real estate, specifically multifamily, across multiple different markets. We've been doing it for a decade now. As you mentioned, the intro, nearly $1 billion of acquisitions in that past decade. Folks, the average investor wants exposure to commercial real estate as part of a diversified portfolio. We are, when people allocate, whether it's 20, 30%, 40% of the net worth to commercial real estate, hopefully they choose to invest with us. In terms of what we're typically in the what's called the value add multifamily space. So we're looking to, buy assets, come in, improve the property, bring rents up to market rent, and that in turn increases cash flow and thus overall value of the asset. And again, we do it, think of like a plane analogy. We are the captain and co-pilot. The individual investors can't afford to hire the entire plane themselves, but they can afford to sit in the seat back in economy and enjoy the in-flight entertainment. So, we all get from point A to point B.
I know when we spoke earlier, you kind of mentioned that you're seeing some blood in the streets. What do you think most people don't realize about what it takes to run a syndication business today in today's market?
Yeah, look, I think we've got to take a historical look down memory lane. So in 2012, the Jobs Act changed, which allowed individual investors to invest directly with operators across a spectrum of deals. And multifamily specifically, or commercial real estate, had a really, really explosion of capital, right? It was coming out of the 2008 financial crisis. It was, some really good yield to be had. And there's a lot of ambiguity in how people were tracking rents or tracking comps or operating deals. And this whole, industry really blew up. And because that investors had more access to directly to deals, they didn't have to be a part of the good old boys club or a country club to get access to these deals. It was widely available online through online syndications and online crowdfunding platforms. And so fast forward to where we are today, we've also, so the Jobs Act changed in 2012. Then on top of that, we had, a very non-technological beast in real estate. Real estate is very mano a mano, or historically was, and had a lot of tech overlaid upon it for good over the last decade. Chuck in COVID, chuck in rent moratoriums, chuck in interest rates, supply, and you get some bumpy roads, right? So, a lot of it's a very old industry raising capital. It's been, and buying deals. But the sort of the retail arm of it really started, got a shot in the arm over the last 10 years. And I was interviewing someone, we really went from our infancy into our, adolescence in the last sort of 3 to 5 years. And we're coming through a bit of a recorrection, specifically in office and in multi. And that's causing some blood in the street. There are definitely deals that are being handed back. higher interest rates. When interest rates go up, values go down. Coupled with that is more supply across the Sunbelt markets, where a lot of markets blew up in population because people could work remote and people started moving to more affordable places like Phoenix and Austin and Charlotte. A lot of supply hit the market. What does that mean when a lot of supply hits the market? Rent actually goes down, right? So and then with that interest rates going up, the value of the asset also goes down. So if rent stayed neutral, if your value would go down if you bought pre-2022. But as rents have also gone down as well, it sort of really eroded it. And so that's caused some headaches for some folks out there. But also has created a lot of opportunities. We're buying a lot of deals today in the market that we think have reset to prices sort of similar to 2018 prices. So we think there's some good long-term value. And yes, some rents have started to come down, but over a 50-year average, if you look at the curve, it's always, rents have continued to go up. So I just mentioned a lot there for you to unpack, but there has been we believe we've hit the bottom, and we believe we're coming out of the bottom and starting to get back into some positive territory, given that we're in a bit of a rate cut cycle.
Okay, no, that's great. Something else you had mentioned before is that you've bought some accounting firms, kind of built an ecosystem of supporting businesses. Why do you think that strategy is necessary for you?
We only just started that. We're early in its infancy. As a company at RSN, we survive on doing deals, right? And when deals dried up, 2 years ago, when the markets were just frozen, when interest rates went from 0 to 5%, doesn't sound like a lot, but that's a 500% increase. Deals just dried up, right? So we were always looking for a different diversification within our business. The word business ecosystem is a great word. Really, if you study a lot of businesses, interview probably a lot of entrepreneurs, and they have multiple things going on that feed. One thing feeds the other, right? It creates, just investing in real estate is great, but investing in real estate and maybe investing in something else like a property management company or construction management company where they can sort of feed the ecosystem just takes it 10x. And that's the beauty of just a high level ecosystems. We were looking for something that back to what I was saying before, like over the past 10 years, a lot of technology, a lot of investors have come to the space. The ambiguity in commercial real estate has really, really shrunk a lot compared to what it was 10 or 12 years ago. And so we were looking for something that was a little bit better cash flowing and had a little bit more ambiguity, right? Older CPA firms or older businesses where there's not a lot of exit options for some of these folks who've been operating for the last 20, 30, 40 years and have been operating a certain way that could use a fresh lick of ideas in terms of putting in tech or bringing in, better systems. That was right for the picking. And so then we also coupled in the fact that, well, hang on, this could be an ecosystem with RSN that some of these folks may have tax problems that they needed to invest in real estate, and there's benefits of investing in real estate. So it's a more of a synergy there. So again, back to just trying to identify 1, ambiguity, 2, good cash flowing, but 3, synergistic businesses that can really add to the overall platform is really quite powerful over the long term. So within the own M&A roll-up that we're doing, it's going to be really profitable for investors, but also in the bigger picture, we think it's going to help RSN as well.
Yeah. Try to be vertically integrated. I get it. I know we were talking before about, different ways for marketing. I know you guys have done meta ads, you've done some dinners. What do you think has worked and maybe not worked for you as far as attracting new investors?
Yeah, look, it's been hard, right? Back the whole thing of the Jobs Act, why did it change? Well, it changed because you can then solicit to accredited investors online, right? Or just solicit full stop. That's what was a major change in 2012. So that then created all these online platforms, think of a Realty Mogul or Patch of Land or these, online syndication, online crowdfunding platforms, I should say, where people can invest with things like they would choose to invest in stocks. It's somewhat similar. And so over the last 10 years, it's become a very competitive space for eyeballs, and that we've spent multiple hundreds of thousands of dollars raising capital online through attracting leads and all that sort of stuff. But at the end of the day, the heart of what we do is for people to invest with us. They still want to have that mano a mano touch. So we've sort of not pivoted away from online advertising. It's just been a different type of marketing strategy, and you can't just dump a bunch of money into ads thinking that's going to reap. Your cost of capital is going to be very, very high. So you've got to think differently for how you get it. Yeah, how you're generating leads. we have done, more in-person events, local dinners, small groups, 10, 12 folks, invite a friend, sort of thing, get to know us a little bit, build up that trust and like. So then when we do have an investment opportunity that some people, want to invest in, they can invest at the right time. So I think it's not, online marketing's not gone. It's still very much part of our portfolio, but part of our tool belt. But we've got to have other things to supplement it, because not just dumping money and having, cost of a lead costing you $300-400 per lead to get on a phone call, it maybe does make as much sense anymore.
Yeah, I was wondering if you feel like investor nurturing is scalable, or do you feel like it's too human driven to automate right now? Because the dinners obviously take time, but have you kind of thought about like how can we scale this that's
Yeah,
not so human
yeah, I
driven?
think, look, I think it goes back to what you're offering as well. Like, I remember talking to a family office, a very wealthy family, and I'm offering them multifamily deals, right? And they said to me flat out, Reid, I can go find 5 of these by myself. You're not unique anymore, right? And that really struck me, right? And I'm competing against other. It's back to that, the ambiguity, the barrier to get into this market now is really decreased, and it's a very busy lane. And I can, sit here and say we're good operators, but there's better operators out there too, and I encourage people to go invest with them as well, because there's a diversification within investing with sponsors. But that's why we're so intrigued about, the CPA firm roll up, because, all of a sudden I'm talking to that family office and they're not getting offered that. Right. And they start to perk up their ears and say, what's this? Like it's different, right? A lot of the investors we talk to who are, interested in real estate or interested in investing in commercial real estate, they're probably seen 7 or 8 or 9 or 10 other offerings at the same time. And they're just like, it's just a fire hose of who's the best one to pick. And so I think it also comes down to your offering and how you can, again, not be so reliant on one product, which is, buying multi and looking at other things like a roll up in CPA firms and raising capital. I think overall raising capital is really awesome for businesses, but also as a CEO of the company, I'm trying to buy things that don't require constant flow of raising capital, right? Because raising capital is a business in itself. There's operating deals, there's finding deals and making sure they work. And then there's a raising capital side of it. And so I want to get to stage one in the future where I don't have to constantly spend a lot of money on ads to find new leads, because we have a great, we've built a consistent database of repeat investors.
Yeah, absolutely. How much of your business incorporates AI technology into what you guys do?
A lot, nearly every part of the business. It's obviously AI is at its infancy. So if we think about marketing, online, the newsletters, the way our podcast is edited, the way we can reach folks, a lot of AI is generated through content. It's very good for that. It's still a little bit naive and early days for financial crunching, but we actually are working on our own AI system, proprietary IP, to create, taking data from all our property management companies and synthesizing it into a dashboard that we're calling Asset Hero, where we can just look at all our assets from deal to deal against property managers in one clean dashboard, across a dozen KPIs, because the KPIs don't change from different property managers. It's, how much leases did you get? What's the traffic? What's the lease trade out? What's your delinquency? These are pretty stock standard, but the way in which Entrata or Yardi or Appfolio may produce it for you is slightly different. And we need a machine to like sort of disseminate it all and print it out, or not print it, but have a dashboard for our asset managers to be more hands-on. And so we're actually in the process of building out that product right now. I think it could even potentially become a commercial product in the future. But for right now, we're just solving for the needs within our business, so my employees can be, 50% more productive with, the way in which they pump out investor reports, because we have a vision in our head that like we can get this platform to work. And if it tracks, if it's tracking month over month, then you can get an AI software to write, couple of paragraphs about traffic, about rents, about collections, add in a little bit, add in a market report, add a bit about the market, the sub-market data. Boom, there you've got something that took my asset manager 2 hours to write is now taking, a couple of minutes. So that we think that's really, really powerful to continue to give more data to our investors.
Yeah, no, we're working on projects like that too. It's really smart, and I just feel like that's where the industry is going. I was going to ask you a little further about that. If you ever thought about like, hey, if I can wave a magic wand and automate one part or one task of marketing or investor relations or a deal analysis, what would open up the most bandwidth for you if you had something like that?
I think it's Asset Hero. Like, the amount of man hours. So as I mentioned before, like the business of what we do and what makes people come back is those are the grindstone, making sure these assets perform, right? And if you don't have data at your fingertips to make quick decisions when you're asset managing 15, 20 big deals, right? You have to be nimble enough. That's what repeat investors do. Having an AI bot that can help me create better online marketing, great. But like the special sauce, the engine is in the asset management and making sure these assets perform. So I think that's why we chose to pick up that specific part of the business and say, hey, we haven't found a product yet that really matches what we need to do to really boost not only the output, but our productivity of people within our organization. So they're not spending, every quarter, it's not like rolling of the eyes. Oh gosh, we've got to get quarterly reports out the door of freaking 25
Right.
assets. And I'm going to spend the next, 40 hours pumping out these stupid, not stupid, but pumping out these reports. I think the technology, and even 5 years ago, that technology wasn't here, right? With language-based AI to really help streamline that. And I think so again, back to the barriers to entry, it's going to then, other operators are going to do the same thing. And so, the richness of data that investors will receive now moving forward because of AI is going to, most investors should be pretty up to date given how quickly information can get pumped out.
Yeah, absolutely. I know you had mentioned earlier about you've been podcasting. I think you've been doing it since 2014. How has it shifted for you? Have you noticed consumption different or topics that you kind of evolved? What is your take on where podcasting has gone, let's say in the last 11 years for you?
Look, I started when the podcasting wasn't a thing, right? It was very new. I started it to build a brand, and that brand has been successful. I've written 2 books from it. It's got me known in a very short period of time. That's what you use online IP for. Today, the way in which, again, back with AI, back with just the online, how quickly things have changed in the last 10 years, you really need to spend a lot of time, a lot of money producing a podcast, right? And a podcast for me, I love getting on and chatting with folks. But what I really do is also, you could spend all your time just literally podcasting and creating content for investors. But, what we do is manage deals, right? We asset manage funds. We need to make sure that we're focused on that. That's just all the top of the funnel stuff. And, you could spend all your time just doing that, right? And not actually creating a profitable business. It's changed in the way people consume. I'm seeing more people using YouTube Shorts, video, where like back in the day, we're on video right now. Like 10 years ago, it was just audio, right? And that's morphed into really needing that short, sharp information really quickly. I don't have a lot of attention, and I'm going to consume it via YouTube. I still think long format podcasting can work. It's just around some of the topics you've got to be able to really be engaging with. Like I look at podcasting today, and the podcasts I at least listen to and I enjoy the most are those with maybe a co-host and have a little bit of banter going on. They tell a little bit about, how their weekend went with the kids, you know what I mean? Like, and it's a bit of, tongue in cheek, that sort of stuff I feel like goes, and, with the occasional guest, that stuff seems to go really, really well. But, it'll probably change in 10 years time from now. Right. So I think it's just trying to keep up with what's creating, but constantly putting out content helps the brand. It helps grow my business, helps attract investors because people can get to know and trust you very, very quickly.
Absolutely. So let's say there's somebody listening right now that's been in the business for maybe a couple of years and they want to go from one to many like you've done. What advice or what scalable move do you think they should make to get to start that process?
And you're talking specifically multi, or you supposed just business in general?
I would say multifamily.
Okay. Yeah. Look, I think today is a very good time to be buying real estate. Like asset prices are at, as I said, 2018 pricing. So you're going back 7 years at this point. At least there's certain markets that I'm in. I think, so picking up a good cash flowing deal today hasn't looked more attractive than it does right now. In the last 4, 5, 6 years, it's been, the numbers were really tight to make work. So I think, but at the same time, I also think we're sort of resetting how real estate investing should be treated. Like we got to a very frothy point where, including myself, we were selling deals every 3 years and doubling people's money. It was just, it was insane. And that's the market, right? Doing that work, not necessarily any special sauce from me, but shifting back to a medium to long-term investment, because that's what real estate is all about. I grew up, believing that if you doubled your money every 10 years in real estate, you're doing just fine. You know what I mean? So having that medium to long-term outlook. But I do think there's a lot of opportunities right now with that blood in the street, finding those assets that are underwater, because a lot of people would have purchased, 2, 3, 4 years ago, and that value of what they purchased it at would be less than what it is today. And that you'd be willing to strike a deal or find a pretty attractive deal. So what I'd say to folks is you always got to be underwriting deals, because the more deals you underwrite, the more opportunities you're going to have to find that smoking deal that's, you can't pass up.
That's great. So if people want to learn more about your company yourself, what's the best way to go about doing that?
You can hit me up, go to rsnpropertygroup.com. That's rsnpropertygroup.com. You can also hit me up at Reid, REED, at rsnpropertygroup.com. And if you're ever coming through Los Angeles and you want to talk shop, go for a coffee, go for a beer, just hit me up on my email, and I'm more than happy to talk shop.
Awesome. Thank you, Reid. Really appreciate the time today.
Thanks, mate.